It will be largely based on the JSE findings document, but there will be obviously some, I suppose if you can say, the author's opinions. By no means do any of our opinions formulate obviously part of the JSE. They've given their document, and we'll talk more about where that is available. But yeah, so let's get into it. I think immediately on the front page, you can see that it's myself in conjunction with Alvin. Alvin's firm is the Consulting Services Hub, and he does a variety of different things. However, for today, we are just going to mention to you around if you need any help with your compilation of your financial statements or any of the nitty-gritty around the technical aspects of it, like we saw with IFRS 15 and 9, new standards, etc. So please, you've got our contact details. You also got the website details. Feel free to give us a shout if there's anything that you need. For some of you, you might recall or have had interaction with me somewhere along the way. Yes, it used to be Kimberly McNamara. It's now Berry. So still the same person. Just yeah, that whole nuptials thing. So Alvin is here with me. He's just not going to be saying a hell of a lot this afternoon. That's up to me. But Alvin, you want to say hi?
Good afternoon, everybody.
So Alvin is just going to be monitoring on the back end for me, just helping with any if there are any questions from your side, just so that I know when to stop or not. Just give me 1 sec. Just want to confirm that we are indeed sharing. Can everybody see my screen?
Yeah, I can.
Okay,
Kim,
great.
so everybody else should be 100%.
Okay, super.
Go for it.
Okay, so moving swiftly then into what we are going to be looking at. So as Earl mentioned, we've got a two-part approach, and that's purely just we wanted to give either side of 15, IFRS 15 and IFRS 9, some airtime. So the report that was prepared by the JSE, they've affectionately referred to it as their IFRS 9 and 15 thematic report. It was issued on the 6th of November 2019, and I've just popped the details of where you can access the report. I've popped it there in case you want to download it in the back end. It is fairly simple to follow. It's only 30 pages long, and for the most part, we have summarized exactly what's on there. So it does help to sometimes have the source document. Going into what the nature was, what was the purpose, what does this review actually entail? Well, obviously only 9 and 15, which made it a limited review. What I'd like to stress here is that we have, on an annual basis, the JSE undertakes a proactive monitoring process. So in any given, mostly calendar year, they will review financial statements, they document their findings, and they then generally release it around the third week, I think, of February. So the one for the 2019 financial statements was released last week. It was issued on the 18th of February. So we have them on an annual basis, and every now and then when something like this happens, where we've got a big changes happening in terms of 15 and 9, and obviously upcoming in terms of 16, they provide a thematic review. So the focus here was specifically on these two standards. It's not intended to be a comprehensive review of a sample entity's financial statements. So they entered into discussion with certain sample entities and then reviewed those financial statements, highlighting only 15 and 9, and obviously the transition and compliance. This is similar to what's undertaken elsewhere in the world, specifically referring to Europe, both in the UK and then the European Securities Market Authority. And you can clearly see that the more work, well, there is just more work being done at the JSE to try and make sure that that investors are protected and that the market is actually of high regard. So that's really the point behind it. It doesn't replace the annual. It indeed actually supplements and complements that process. What was the point? We often think that these reports are some kind of stick to beat ourselves with. Definitely not. So this report highlighted a lot of good compliance, gave us a couple of good examples in that regard, and also highlighted some to avoid. There are some less than desirable disclosures that have also been shared with us by the JSE, and I think it's quite easy to see when you're about to fall into that trap. The point behind this review, I suppose, behind issuing the report, we all might think that, well, I've already done that. I've already complied. My first set of financial statements is out there. It's sorted. Well, I'd like to draw your attention to the fact that at the bottom of the slide, the anticipation of IFRS 16 is still pretty real. Even though I think almost every entity, I don't think there's a year end that's still waiting to apply IFRS 16, but we are indeed still waiting for the first set of financial statements from such entities. So a Feb 2020 year end will be complying now with IFRS 16. Likewise, a December 2019 year end had to comply. And really what it's saying to us in giving us this report is don't make the same mistakes. So that's one thing to look at it with as a helpful tool. The other one is, even though our financial statements have perhaps already been published, addressing 15 and 9, the question is whether those results encapsulated and provided all that was necessary in light of 15 and 9. And I think we could probably all admit that not so much the case. I think for a large part of us, and we'll see that finding come through a lot, that we jumped on the bandwagon perhaps a little on the late side. And whatever we identified was with a fair amount of rush and just wanting to comply with the bare necessities. This means that the likes of your accounting policies might not be where they should, or might not be anything worth writing home about at all. It might mean that your disclosures need refining or perhaps some development from scratch. So there are a few things that we might not have hit the mark with. And what this is giving us is an opportunity to fix it. That obviously doesn't mean that we were in compliance in the past, but I think that we've got to be careful not to say, well, the report's already been published, it's old, my financials have been published, there's nothing for me to do with this. I think when any new standard comes out, I think we see the first couple of years where we need to reconsider on an annual basis what we're saying. Does it make sense? And is it in the true spirit of what was actually required of us? So twofold, a bit of a back look, bit of a forward look, application to IFRS 16. And then, interestingly enough, audit committees actually utilize these kinds of documents, so the proactive monitoring as well as the thematic reports. And they obviously engage with the entities regarding these highlighted issues. Have they been appropriately addressed, both before and after the fact? So yeah, I think helpful all round. It wasn't a prelim format back in July 2019, but it was finalized and issued to everybody, and it is available on the website, like I said, at that address earlier. So do feel free to have a look at what the JSE give us. They're always rather helpful as opposed to sticklers. So what are the 5 main focus areas of the document? Well, the JSE put them into categories or headings per se called general issues, accounting policies, key judgments and assumptions. They dealt then with the specific disclosure requirements of each standard respectively, and the transitional requirements. So the transition requirements, obviously as an overarching concept, what was missing, but also addressing in individual aspects per standard. When we have a look at the general issues, we look more around alignment. So the first point was that perhaps what has been published, and this is twofold, whether that be in prior results, so if you're looking at your previous interim results versus your final annual results, they're saying that the information didn't correspond. So you can't say one thing and then 6 months later say a different thing. That's going to create confusion in the market. So the idea was that we make sure whatever we present or provide in any published format, whether that be, trading statements, etc., that aligns from period to period. We'll see later, one of the slides that I've prepped, and one of the findings was that we need to also make sure that we address if there was something missing in the most recent interim period, then let's put it in the very next set of financial statements. So don't simply keep quiet because, oh, well, we missed the mark, so no biggie, we'll get it right in the annual. The fact is, by getting it right in the annual, you're drawing attention to the fact you didn't get it right in the interim. So if you own that fact, you say as much, it obviously avoids any confusion. Market, JSE, the works. The second point is just around, did you have orderly notes? Is what you said concise? Is it coherent? Is it cross-referenced? So really, one of my pet peeves is when financial statements just don't tell a story from start to finish. And really, when you think about it like that, any set of financial statements that are published are there to tell a single story from start to finish. So we'll again see in some of the individual comments or findings that were raised around where a point was made outside the financial statements, whether that be in the annual report under some commentary, or whether it be in the director's report, or even in the audit report as a key audit matter. You can't have it being raised in one place and not in the other. By virtue of raising it outside the financial statements, you're implying that it's significant. I mean, it was significant to talk about. So perhaps then it should have been addressed in the financials. And these are the things that are easily picked up when we have a look at a set of financial statements from cold perspective. Applying requirements in interims, we'll go into more details as well, but bottom line is, IAS 34 often undergoes changes as a result of new standards. And these are not always known when our interims are published. So we prepare a set of interims, we go with them based on, well, it's condensed, it's supposed to be summarized. No, I'm not providing 6 pages of notes, and we go. And like we saw with IFRS 15, the revenue standard, it caused a change in IAS 34. And it required us to present disaggregation of revenue. So that whole note needed to be prepared in your interim. And if it wasn't, that is obviously clear non-compliance. So application in interims is really important to check whether it has been changed from the new standards. In addition, regardless of whether changes have occurred, the standard IAS 34 in general says, well, if there's been a new standard, a new adoption, we need to go to IAS 8. And IAS 8 then gives us clear detail on what to provide. Indeed, Alvin's just liaising with me, obviously very silently at the moment. It's also important that even where it's not necessarily published situations, so we are looking at this from a JSE perspective, obviously for listed entities, because that's the report we're using as our basis. But indeed also shareholders of private companies where it's not a chief cook and bottle washer situation. So any type of stakeholder really needs to have this information provided to them. Otherwise, you're running the risk of just simply not giving them what it is that they need to make educated decisions. Ultimately, investor of a listed, investor of a non-listed, they all want the same information and should have that provided to them in the financials. When we take a look at accounting policies, I think probably one of my favorite things is when you review a set of financial statements, do the accounting policies tell the full story? Because they underpin, they are what help a user understand whether what you've done in the financial statements actually makes sense. So to simply show a revenue amount, that's wonderful, but it doesn't tell me how or what amount, what was taken into account, what wasn't. And therefore, we need to make sure that they're entity specific. This is a big bugbear of the JSE, and I think of most external reviewers, as well as have all relevant aspects of each IFRS indeed being addressed. And you'll see later I've actually got a little picture that says silence is not always the best option. So often we go, well, by omitting it, we're implying that we don't need to comply or that it's not relevant. Well, sometimes when we're applying a new standard, it helps to actually make negative statements like that or explain further where we can to help the user understand that whatever it might be is not applicable to us. For example, a refund liability. If you have non-refundable fees, well, then clearly you don't have a refund liability and should never have one. But if you don't provide it, you kind of leave the user open to a bit of guesswork. On key judgments and assumptions, also a fairly topical and unpleasant area of concern. I think we all know where we're sitting in terms of our profession, and that there's a lot of onus on judgment. The less we have, the better we feel. The less we have to make a call, the better we sleep at night. But I think what's important to know is that when we are preparing financials, we do make judgments, and these are often clearly required by the standards. So IFRS 15 talks to quite a few. And in that instance, we need to tell the user. If we don't, I have no idea how they're supposed to make the assumptions around what you have and haven't done. So we'll look to specifically addressing IFRS 15 today. Around the judgments, we're going to look at the likes of what have you done around the amount. So, for example, is there variable consideration? What judgments have you made around recognizing the amount and when and how much should be put in at what point? So when we look at revenue, two questions come to mind, and that's all there really is to it. How much and when? So what is the amount that I need to put in and in what period? And if there are any judgments that you've made around that, and the standard gives us quite a couple of clear ones, tell the user. It goes under the judgments and estimates note, often a separate note under the policy section, and that's often lacking. I think we also need to be quite clear that most of us use software, like, for example, DraftWorks, and it seems quite easy when we just simply go and click on a couple of notes. The onus is not on the software provider per se to make sure that your financial statements tell your story. They've built in everything in sundry, but it is still the onus of the preparer to make sure that it tells the story of the entity. And for that, I can't highlight enough that it has got to be entity specific. You cannot take at face value by purely having switched something on that you're good to go. It needs to be applicable. And you'll see that kind of theme come through the entire review of the JSE and throughout our presentation. Then we'll look at some specific disclosure requirements of each standard, and then the transitional requirements, as we've already mentioned. Let's take a look. So there were 6 groupings as such of general findings. So these were overarching. We found these whether we were looking at the IFRS 9 or IFRS 15, and the JSE gave us a couple of examples in this regard. First being our alignment. I've already touched on that, but our alignment between financial statements and perhaps your interim results. So that's more than just financials and interims. That could also be your financials pre-adoption. So in a set of pre-adoption financials, we would need to put under that standards and interpretations note, we would need to say, what's the impact? And the standard comment is sometimes, we're still assessing. Now, this is not appropriate on any day of the week. When you publish your financial statements or share them with your shareholders from a non-listed entity point of view, it's already live in the period that you would have had to apply these new standards. You can't then be wanting to assess what the impact was or wasn't especially around something like revenue. We saw with trade and other receivables, because of the changes in IFRS 9, we saw the effect on impairment. And this was huge for some entities because never having had a policy per se, or not having had a strict enough policy around credit risk, it impacted their bottom line, their profit or loss amount, quite greatly. So we need to be very, very careful about what we say in a pre-adoption set, and then obviously where we go from period to period. Assessment of materiality, that age-old fun dog where we have to go, what is that? Do we look at it from a balance sheet point of view? Is it a profit or loss amount? Can I use audit materiality? So we'll take a look at what their finding was and their comment was there. Financial reporting systems, again, if you haven't considered the impact early enough, you will likely not be able to generate the new info that is required. So with new standards often comes new disclosure requirement. And if I can't put it together, well, then I'm going to fail on the compliance. The argument with some sample was that, well, we simply couldn't get it, so we didn't provide it. And unfortunately, you'll see that excuse ain't going to fly. Excuses for not getting information is not a reason to not comply with IFRS. Some housekeeping matters. Was it in the right place? Did it say the right thing? We'll talk a bit more about the accounting policies and the fact that they are often generic. Saying something that's generic could essentially apply to any entity. Now, in some instances, yeah, I get that might be arguably important. But to put in your standard revenue, in your notes, you put in just a standard revenue note that says revenue is X, we sell goods and provide services, and we recognize revenue at a point in time and over a period of time. Tells me nothing. And is not even, it's not even within the spirit of the standard, it's just completely outrageously non-compliant. So we'll have a look at that. Also the fact that there were some comments, some findings around duplicate accounting policies, irrelevant accounting policies, like saying I've got a policy on provisions, but there isn't one recognized in the financial position. Why? Why would you have a policy but not the amount? And sometimes including the policy helps a cold reviewer go, is there maybe a provision that's been included incorrectly somewhere else? Because I appreciate that mapping is a real thing with trial balances, but it's more often the other side where we've just switched on every policy under the sun and gone, okay, I'm covered, just in case. The fifth heading is just around inconsistencies between the financial statements and the audit report. So again, it's that concept of making sure that things align, that we don't say something elsewhere in the financial statements or commentary for that matter, or annual reports, but the financial statements don't say it. And then lastly, just an impact on, again, that transition. Transition is a big finding throughout. So on that first one, I think I've mentioned in a fair amount of detail now that basically our financial statements at a reporting period need to say, in line with what we said, either in the interims or in some sort of pre-adoption. So pre-adoption, as I'm saying, that's your set that had the standards and interpretations note not yet effective, which impact is still being assessed is our go-to. No longer. Like if I read a set of financial statements like that, it says a lot around the quality of what I'm about to review. It means that we haven't paid enough attention to a project that's probably a lot bigger than we think. And as a result, we're just going to leave it, which is completely human nature. We don't like change, especially not a change that's going to make us pretty much rethink everything around what we've ever done. And that's the nature of accounting, really. It's trying to stay abreast of all the new, but at the same time, make sense of it. And that's hence why you've got the likes of Alvin and I. I'm sure that there are a lot more of our kind out there that would love to help. But if you need any assistance in this regard, just a once-off cold review, maybe once every other year, with new stuff coming out. Does it make sense to you? Okay, great. I'll make these changes. I'm not making those, and you go from there. But to simply just hope and pray that you're compliant, I think is where we often find our downfall. I've mentioned also already around changes that are made to IAS 34, often as a result of the new standards, and we simply don't even know that they're there, or we provide the précis version. So we really have to be very careful what the requirement is. You'll see in a later slide, I have highlighted it's paragraph 16 and it's L. So paragraph 16L categorically said, give me your disaggregation of revenue. Boom. So whatever you're providing in your full, you need to provide in the interims as well. On that note, since we did mention that the purpose of this thematic review was also to help us get on board with IFRS 16 sooner, IFRS 16 has not resulted in a change to IAS 34. So there isn't any specific requirement included, but obviously, as I have mentioned also, we are required to provide our disclosures in IAS 8, paragraph 28. So those are the disclosures around what is the impact of this change on each financial statement line item and EPS. We'll talk more about that now. In lieu of the misalignment between full financial statements and interims and pre-adoption, the JSE has requested that. And this is quite cool. They're saying, just own it, just be transparent. If you've left something out or there's a misalignment that has happened, own the issue, be transparent about what it is, and provide the meaningful explanation of what the misalignment is that has occurred. So whether that be that your interims didn't have the appropriate note in, then provide it later on. If it is a question of, we said there was no impact and now there is, explain why the change. If we're looking at IFRS 16 and we quantified something as at, let's call it a June year end, and we quantified something at June, and 6 months later in the interims, we quantified kind of a little different, explain it. Don't hope that it's going to go away or argue it's immaterial. Explain what the difference is as a result of. Maybe it's an insignificant subsidiary that got lost along the way. Maybe we all know what year-end procedures are about, and it obviously things can fall through the cracks. The sooner we own it, the better. It's just to really enable investors to have a full understanding on the interim. So if we have left something out, the JSE is categorically saying to us, just provide any correct or omitted disclosures in your next annual result. So that would then imply to me that we would have maybe a page or a section or an addendum or a part to the financial statements there explaining what a corrected or omitted disclosure is about and why it's now here. It's also to provide the investors with appropriate info. If we wait another 6 months or more, obviously, to get your comparatives out, interim versus interim, it's now really late and it becomes irrelevant to the investors the longer we delay that. We've got a little crying man on the right here, and this little crying man is basically just the sample entities and what they had to say about the problems they faced and what preventative measures they would have taken with regards to the findings that were raised. So one of them is they're saying they should have established the implementation project a lot earlier and should have provided more resources. So earlier and more resources. Alvin, I don't think there's a client that we've come across that has said, oh, we're starting too early.
No, not at all.
And ultimately, whenever we have started, what we would think is, oh, okay, this is a good time. There still doesn't seem to be enough time to fully grasp every complexity. And unfortunately, it then comes out of the woodwork. If I can just move on to the next comment, which is pretty in the same spirit. just saying that the uncertainty that could have existed at interim, or if you started even earlier, they only come to light, they only crystallize at the first annual reporting period. Because then suddenly I think everybody's just, they heightened to what's being required. They really do feel the need. There's a lot of pressure to get it right. And suddenly we realize that something has missed. I mean, no matter how in detail we've ever been with a big or a small group, there's always something, that should have been in the disclosure. Smallest sentence, whether it be a negative statement or not, it really is just a question of can't start early enough. That second comment is also in line with what I was saying earlier about there will be no material or significant impact of the new standards on the financial statements. No, never. I don't think I've ever seen a standard that is not going to have an impact unless it's not applicable to you. So there's a discussion we can have another day. Kim, how do we deal with the standards and interpretations? Note, for those standards and interpretations have no relevance. For example, biological assets. They can make 20,000 changes to that standard, and majority of the companies out there are never going to bat an eyelid. So not only is it completely relevant to say that there will be no impact, but it's also relevant not to even include it in the first place. So there's a balance there. There are a variety of entities that choose to put in the list and then go through the list going, no impact, no impact, no impact, no impact. Or alternatively, include only those that are relevant to the company and then assess whether there is or isn't impact. I think it's done as an afterthought, that note. And I'm not sure that there'd be many of you out there that could argue with me on its afterthoughtness. It really is not a main concern for many of us. So uncertainties that crystallize only at annual, and then obviously the fact that we make such statements could be based on quantitative impact, and we're saying, well, there won't be an impact on my numbers. But ladies and gents, I cannot stress enough. What about qualitatively? And we saw it now with the likes of IFRS 15 and 9. So where your revenue, even if it didn't change, so if you've always recognized it and it's still the same, and it's all we've done now is change it from calling it risks and rewards, and it's now the transfer of control, and I appreciate the wording, it's frustrating, but if the concept never changed, well, I can guarantee you your disclosure had to. And with that, your systems had to, because you had to get the information out of your systems in order to give the disclosure. And some of us might argue that the disclosure, why give it? It's not relevant. Well, I think we've all got to jump on board in the fact that we're in 2020, and acquisitions, mergers, these divestitures, it happens so quickly and so prolifically that we need to make sure that we are indeed providing the appropriate information for any investor at any point in time to make sense of your financial statements. We shouldn't need annexures or addendums of any sort to clarify. Still a little crying man, 3 more comments, all of which we have mentioned already. So they said, the sample entities said, well, it's a little bit sad. Our focus was on measurement and not enough on disclosure, both qualitative and quantitative. The fact that entities missed completely that IAS 34 had this new requirement in terms of paragraph 16L. And then lastly, just one more comment saying, perhaps they should have used what they would normally have at their annual reporting procedure is to rope in an external IFRS expert, whether that be in some kind of a consulting or just a pure and utter once a year you review my stuff like Alvin and I do. They were saying that they wish they had. They wish they'd done that at interim period, because then they wouldn't be sitting with the egg on their face, having seen a finding of something that was so basic. So, testing your own procedures, your robustness of what you're saying and what you understand, a standard to say, The only way you can do that is in a consultative process. And cost versus benefit, I'm not going to go there. I think we've all got our own opinions on cost versus benefit. But I think when you get a letter from the JSE, you kind of go, I wish I would have done anything to avoid a finding of any sort, especially one where you have been caught with your pants down. So really cool. I think that they provided some of the feedback from the sample entities around what they wish they could have done better. Let's take a look at the next one. So the second general finding was around the assessment of materiality. So I just want to start at the bottom of the slide actually and say to you, well, not too many of us will be familiar with the IFRS practice statement 2. Its name being the making of materiality judgments. It was published quite a while ago. We're looking at almost 2.5 years ago that we were given this document. It was published by the ISB, but it is not mandatory. So we don't have to be in compliance with it to state compliance with IFRS. But it is super useful. It gives us a lot of context as to what needs to be thought of in applying judgment. And with it being such a prevalent concept throughout the financial statements and basically what we do every day, I find it quite a helpful on-hand guide to just keep yourself in check, that you're not being too fast or too loose. One of the things it does address is that the materiality threshold that we need to be considering or applying from an IFRS point of view is not your audit materiality. I get the point behind using audit materiality because then my auditors won't raise a problem. But that can't be our outset. I think as preparers and owners of financial information that's been given to investors, we need to understand what we think is material in the context. So just jumping back up then to the top line, we see here that we've got to consider it both at a balance sheet, a financial position, as well as, for instance, a profit or loss level. And the example that the JSE addressed in the document was that a financial asset might not be large in comparison to its other assets in the balance sheet, but impairment of that financial asset could be quite significant in profit or loss. So the disclosures that I would then expect to see would be as a result of it being a significant impact on my profit or loss, as opposed to arguing, well, it's irrelevant from the balance sheet point of view. And I think that's where the balance needs to be struck, is that we don't want to simply put in everything just to cover all our bases, because there's nothing worse than reading through 60 pages of financial statements that say nothing. But we also don't want to shy away when there is something that's worth noting, that's worth addressing, that's worth drawing attention to. So just there again, the comparison or the concern with going balance sheet versus P&L versus which one's right. There really isn't one. It's where the whole concept of judgment comes in. And again, just addressing that qualitative assessment, that we need to look at this holistically. It's not just from one end of scope. It's all and sundry. So to be careful that we also consider it in the objective, in the spirit of what a standard is actually asking of us. Whether that be quantitative, qualitative, you name it, make sure of it. The next general finding was around the reporting systems, as I mentioned already, and new disclosures will require system changes. Full stop. I don't think there's any disillusion there, but I think what we sometimes want to argue the cost versus benefit, and we all get it. A costly exercise, well, is it really going to benefit me? I think we've got to be careful in light of what's being asked of us, especially when a new standard is implemented, and especially in view of the type of information that's being asked of us. So IFRS 15's disaggregation of revenue definitely did require a lot of data to be collected by an entity. And many people say, well, why? I think we just got to go and look at what IAS 18 required of us in terms of its disclosure. And I'm just going to leave it hanging there for a second because it was actually nothing. We had no disclosure requirement. We gave revenue in the SPLOSI, in our profit or loss, full number. And then the note, if we were lucky, there was a note that said sale of goods and rendering of services. And if we were even more lucky, we actually had a main business, your principal activities or whatever, addressed on an information page. And it might very well have said that we're in the business of logistics, or we're in, we run a warehouse. So the very thing that made a company tick was nowhere to be found. So we've got to understand what the purpose of IFRS 15, what the objective of its disclosure requirements are, and make sure that we don't use the cost versus benefit argument, because that, like I say, just simply isn't going to stick. Under IFRS 9, so as I've already said, we will address more in detail on Thursday, but IFRS 9/7's requirements also around the dates, so your time buckets of your debtors. There's some information that needs to be obtained from reporting systems there, and simply not being able to get it. I mean, it was actually addressed in the report. If you are following with me, you'll see that the JSE raised the findings saying there was an issue around a sample entity and their data sitting in 120 days, and they simply said, sorry, we can't generate the info. That's just not acceptable. On our slide 13, we've got the next one, which is housekeeping matters. And you'll see my little picture which says full disclosure, and there's a full stop. That's it. Ladies and gents, it can't be more clear than one little picture. Give us the full picture and it's done. That doesn't mean overdo the picture either. There's got to be clear, concise, to the point, and you can call it a day, literally drop the mic, you're done. I've got 5 bullets here. First one is incorrect use of old wording. There's some standards that say you can still use the wording that was used, in previous standards, as long as it says what it needs to say. But I'm pretty sticky like that. I'm a purist. So for me, the age-old one that sends me into some kind of heart failure is on the screen right now, and it says provision for bad debt. I know that there are 1 or 2 old ancient standards that still have this written somewhere, whether it's in their scope section or something, but this is an absolute no-no. IAS 39 addressed it as an allowance for credit losses. So that is essentially the old wording, and now our IFRS 9 addresses it as a loss allowance. So you have a loss allowance for what we affectionately abbreviate as ECLs, expected credit losses, and that's it. So in other words, what this is talking about is you can't be interchangeably using these things, and please definitely don't use that. Be consistent. And if the standard is prescribing an IFRS term that makes full sense, why not use it? Then everyone's on the same page, surely. So that's one. Another one is, obviously in terms of IFRS 15, we've got the new wording is contract liabilities, basically representing that you still owe your customer something. This, in the past, was referred to as income received in advance in some cases, and in some cases, deferred income or deferred revenue. I like to think that there's a distinct difference, especially if you're talking about maybe companies with government grants. That definitely, very, very unlikely should form part of their revenue. It would likely be part of their, if they received it in advance, it should be deferred income. So replace your income received in advance notes with contract liabilities, put it on the face, calling it a contract liability of your financial position. And in so doing, move with what the new standard is requiring of us, not a half approach. Ordering of notes, important that I just want to highlight here. IAS 1 just gives us some clarity on what it wants there. It's fairly straightforward, and we might all go, well, that's pretty obvious. But it doesn't always come through as obvious. Sorry, I hope everyone can see the yellow. I won't use it again. It's not the most standout picture, but it asks you to do it in a systematic manner. And again, what does that mean? Well, if you're presenting your financial position first, it stands to reason that the first policy, and therefore also if you are doing your policies, in bulk and then your notes, and therefore the first note would be PPE. If you're doing your profit or loss first as your first statement, which is not the most common presentation, but if you are doing your P&L first and followed by your SFP, I'd want to see revenue first because it's the first line item. So it's all about that systematic manner that is addressed in paragraph 113 and 114. It gives us some quite clear guidance. Third bullet, contradictory messages. Sure. This stems from also the alignment between the different reports, so period on period, saying different things, but then also within the very same set of financial statements, annual report, or commentary-wise, or whatever the case might be. Say the same thing. One of the comments I think was raised, the finding was raised that somewhere the sample entity, I think it was outside the financials, there was commentary and the sample entity said X about a revenue stream. And then in the financial statements, there was nothing mentioned about that revenue stream. So when the JSE queried it, they said, but it's an insignificant stream. Well, it can't really be insignificant if you're talking about it outside the financials. So we've really got to make sure that what we're saying when we're not in the confines of the financial statements is not perhaps highlighting something that should be addressed in the financials. The last two go back to the policy issue. I know it seems repetitive. If it does, then that's it, because that's the job I'm trying to do today, is to get across to you guys, or all of us really, a reminder that we can't include policies that don't apply to the entity. This speaks, if I use it in confines of IFRS 15, we can't have something being said in the policy about a refund liability, but the company doesn't do refunds. Likewise, taking a visit down to a different standard, we can't have a policy, as I said earlier, for provisions, but the company has none. So this is where that critical overview, often a cold view, a third party, plays one hell of a role. Generic policies, if I could read it with any other company, it probably isn't telling me anything. We see often with provisions, telling me that a provision is a contractual obligation of this and that and the next thing. All we're doing is repeating IFRS. That's not a policy. A policy is, what are your provisions made? What are they made for? Fair enough, you can say that they are an estimate, a best estimate of the future cash outflows. You can explain maybe something around the timing of it. Kim, aren't I duplicating the note? Well, these are the things you need to consider. So don't duplicate, but also don't just put out IFRS in its totality by quoting paragraphs and paragraphs of generic information that means nothing. You'll see often throughout the report, and perhaps in some other reports, you'll see that the JSE talks about boilerplate accounting policies. That just means it's same, means nothing, says nothing, don't do it. Last on the general findings is the impact of transition to new standards. And this is really tying into that message that I had earlier, that the JSE said, if you've done something, and it was an error perhaps in the past, when you go over to a new standard, please don't try and hide the error by saying it's come to light as because of the impact of a new standard, and therefore it's part of your transition. Nonsense. So we have to make sure that we separate and separately talk about what is the impact of a new standard versus, when we did this analysis, out came the dreaded error. Errors are addressed in IAS 8, a section all on its own, whereas the impact of new standards also addressed in IAS 8 and very likely in that specific standard as well. So I appreciate that we're kind of going, well, Kim, it's all IAS 8, really, and is it all that different because I'm doing it by line item? Well, yes, because the user needs to know if we've made an error somewhere else, somewhere throughout the financials, somewhere throughout the life of whatever the item is. Currently, even looking at a company where there's an error relating to disclosure only. So is there a note required for it? Well, I'm not going to bore you with the detail, but bottom line is we're dealing with an error that relates to disclosure that was incorrect, no impact on the financial position, and no impact on profit or loss. So this is where I say, companies need to be careful, especially of us, the listed ones, around what needs to be reported to the JSE and in what format. Because I am aware, I think it was the last one that they issued around how to report errors to them was published in 2016. Again, all of this is on their website. But we need to be very careful that we talk about these things and own them in order to create ability that's required, I suppose, not even deserved, but just needed in 2020 in a very tough economy and a very tough time for our profession. So on the IAS 828 requirements, I just wanted to highlight the three things. This is talking specifically now to when we have an impact of a new standard. So one of the findings that the JSE raised was rather interesting. Look, I get it. People want to kind of say what needs to be said concisely. Isn't that one of the things that we're supposed to do? Well, yes, we do get to the point quickly, but we still need to comply with overall IFRS. And what this paragraph, IAS 129, says is that you need to make sure that you present separately items of a dissimilar, spelling 101, dissimilar nature or function. So ladies and gents, I think it's quite clear that when we look just at the basic name of revenue and financial instruments, these two things have, just their own beat of drum. And we could not, under any circumstances, have aggregated the impact. The user could therefore not find anything helpful in that. So the JSE categorically just said it's unhelpful and obviously contrary to the IAS 129 paragraph. The two parts, and I'm going to stress this because IFRS 16, those of us that haven't yet published, this is important. Every single line item that is affected by a new standard, they want the impact. This means when we look at the assets, the right of use asset coming on, the lease liability coming on, if you in the past had that operating lease accrual or asset smoothing, what are we doing with that? Don't be quiet about it. I mean, it opened on your first day of your financial statements. Where did you put it? When we look at profit or loss, what line item is affected by your depreciation increase and your finance costs and the reduction in your operating lease expense? Don't forget about that. And then obviously if there is any subleasing or any of the other funky monkeys coming through. And then the last one, which issue bar none, is what is the impact on earnings per share? Assuming you need to obviously comply with IAS 33 on earnings per share. But obviously for listed entities they do. So the question was, why is this left out? It's a clear requirement. And if you've done the impact on each line item, you should be able to assess whether your earnings was bigger or smaller or whatever the case might be. So this here, so very important on that issue. So just under the transition effect, this was given to us as a good example. The JSE, obviously, they don't name and shame the sample entities, but the JSE gave us this example. I like it. It's also, for those of you that are comfortable with the illustrators issued by the bigger firms, let's just call them that. I don't know if we do have big 4, big 5, big audits, have obviously got their own illustrators that they issue and freely available on the internet. And this is one that makes a lot of sense to me. So what the JSE commented on here was, good job. It gave me the nature, the timing of the satisfaction of the PO, the performance obligation, and it dealt with significant payment terms. Ladies and gents, this here is required every year. I need to understand what it is that you do, when you do it, how you do it, and what are the payment terms that go with it. What this sample entity then did was, in lieu of changing the accounting policy, they said this would be the nature thereof. This is how it's going to change. And then what they did, which I think is obviously just wrapping it all up and putting a bow on it, was discuss the impact. And it didn't stop there, because what they then did was they took that impact and they tied that back to their recon of impact on retained earnings. And I think when you've got that, when you can fully explain to a user, this is our revenue stream, this is the nature of how it's going to change in terms of the accounting policy. You could also have done an old versus new, perfectly fine. This is the impact that's going to take place. And then you quantify that. You put a number to it. Boom, you're done. You couldn't make it any clearer. So from that point of view, I think this is probably a good place to call for our break. But from that point of view, I just want to highlight that there are so many illustrators for us to use. It's finding what you're most comfy with. Some of us might take to wherever we did our articles. If that makes sense, we've used it. And for others, it might just be a question of time, getting comfortable with them. Each entity, each illustrator's address is sometimes a different entity, sometimes just a blank entity. And that can take some getting used to. But I want to implore of you that you do have these available and you're not just fighting in the dark. So using a software, great, but let's not put the onus on all of them on their own. So we're going to take that break and we'll catch up with you shortly. Learn even when we're presenting. So thanks again to Draftworks, to Earl and the team, and to all of you that have dialed in. So let's jump into the second half. So the first half, we dealt with some general findings, really just looking at what was the purpose of the JSE's documents around the thematic review and what issues did they raise. One of the comments that came out, one of the questions that came out during the first half was, is there somewhat of a glossary of terms, like an old versus new? I mentioned about, for instance, income received in advance, we should call it contract liabilities. On the face of it, unfortunately, the answer is no. And that's just because we've really got to look at what are we dealing with. I see a set of financial statements, and if it says deferred income, my immediate is to perhaps say, oh, there's a problem. But maybe, as I mentioned earlier, maybe it is indeed just a government grant that they're showing as deferred income, in which case that's perfectly fine. So the standard also introduced contract assets, for instance, which we've never seen before. It's kind of like a pseudo asset, a pseudo debtor. It's where you're not yet entitled to receive the cash, so it's not an unconditional right to cash, which is the definition of obviously a debtor, a financial asset. But you have done something. You've already delivered something to the company, to your customer. So by doing something, you're entitled to receive, to consideration, but it's not yet cash. And the reason why you're waiting is something other than due to time. So I know that sounds like, jeepers, Kim, okay, just call it what it is. A contract asset is basically where you've done something, so you're due something, okay? You due some consideration from your customer. But in terms of the contract, you're not yet entitled to receive the cash. So you still have to deliver product B. So you've done product A, And for that, you have a debtor. But because you're not allowed to get the cash from product A until you deliver product B, we call that a contract asset. Which seems, for most of us, I get it. For most of you out here going, these people are daft. I get it. I don't write the standards. I try and make them simple. As Earl introduced earlier, we try and make some of the practical aspects fit into the principles of the standard, and vice versa. We just, got to make sense at the end of the day, but we also got to be able to say we're compliant. So those kind of things we unfortunately need to look at. It's makeup. What is it made up of? What is it doing? It's not that simple. What does work, and I can kind of do this as a kind of makeshift for those of you that want to embark on this journey, maybe on your own for a bit. IFRS 15 has got 4 appendices to it, and Appendix A is the definitions. It contains the definitions, and by virtually just reading, it's not even a long appendix. I think it's only literally just a page long, a page and literally maybe a sentence, and you'll be able to quickly figure out what the definition of something is. And if you're unsure as to whether you've got a contract asset, you pop the deeds through. We have a look at that in isolation, and Bob's your auntie. You can move on. But I think for ease, I'm able to say if you had income received in advance, which was true revenue received in advance under IAS 18, that guy's got to be called a contract liability now. That's just the wording. The standard does still say, call it something that makes sense, but you're talking to some purists here, and call it what it is based on the new standard. That would be stupendous. So yeah, unfortunately, I'm sorry I can't give you a glossary of old versus new. I haven't quite written that dictionary yet. But I think for the most part, if it's just a quick one, easy call, we can solve that with a certain amount of world peace. So let's take a look at what the standard specific findings were for IFRS 15, bearing in mind we will address these for IFRS 9 on Thursday afternoon. So it'll be more dedicated to the grumpies that came along, the true gremlins that came along with financial instruments, specifically debtors. So 5 headings, albeit that the first heading called general was not something major. So I just want to address that agent versus principal. So that's the only thing that they spoke about under general. And agent versus principal is a concept we've looked at ad nauseum, really, even under the old IAS 18. And we had guidance given to us, which was interesting. In IAS 18, it was in the illustrative examples. Okay, there was a paragraph that gave us 5 criteria. I think it was 4 or 5 criteria. And if we met that, we were an agent or a principal, whichever way it fell. Under the new standard, this guidance is incorporated in Appendix B. And we have 3 criteria, 3 main criteria of the old survived. And for the most part, it hasn't changed. Honestly, I haven't come across a query where someone's asked me to assess and, oh, it's different now. It's a rare occasion where you're going to come across a change in an agent versus principal situation. Not saying there isn't, but I'm hesitant to say that it makes sense, that there should be. So if that has occurred as a result of transitioning to IFRS 15, the question raised by the JSE was, is this not an error? Did you actually do this correctly in the past? So there's twofold there. If you are talking about an agency versus principal situation, you might just want to say that this was dealt with like that also under the old. So that's sometimes something just to be careful of, is that, again, is it a change? Did we do it right in the first place? Should we be even drawing attention to it? Yeah, and that obviously addresses also then the next part, which your accounting policy should say what it needs to. So the next 4 headings were very similar to what we saw under the focus areas, as well as in the general findings: accounting policies, key judgments and assumptions, disclosure requirements, and transitional requirements. Let's take a quiz. So under the accounting policies, I've just addressed, and again, forgive me for the repetition, but I think it's important that we really grasp what their issues, what their findings were all about. They pretty much lose their minds over generic or boilerplate. And I've already said that if you're saying something in a policy that could be used for someone in a mining company versus someone in retail, you're probably not saying anything worth saying. Now, when we click on notes in companies like DraftWorks that provide us with the software, the onus is not on them. The onus is on us to make sure that it says what's appropriate for my company. In addition, we also sometimes see duplicated accounting policies. I'll talk more about this under IFRS 9 because that's something that seemingly is more of a bugbear there. Interestingly, the duplicate accounting policies appear where we've got more than one financial asset and we keep saying the same thing. So, and that's a love of a lot of entities. I get it. When I was in audit, we did the same thing. The more the merrier. Click every note in creation on. Your financial statements are 60 pages long. Great. They say nothing, even better. That's really not what we're trying to get at. So where there's a duplicate policy, we need to just rein ourselves in. It also doesn't look that great when you're saying the same thing twice. In the second block, the middle block at the top row, we're just looking at a link between the revenue streams and the policies. Now, I'm just going to bounce back 3 slides. So you'll recall I spoke about this right at the end of the first part of the session. And this was a sample entities transitioning note where they addressed what is the actual revenue stream. So for all intents and purposes, that's addressed somewhat there. Then they spoke about the accounting policy, what was the effect of the change, and then the impact. Now, similarly to that, if we look at, and I'm just going to jump ahead a couple of slides, please don't stress, I'm going to come back to what we need to be, where we need to be. If we have a look, for instance, at on slide 25, I've given you an extract of one of them that indeed the JSE highlighted as good disclosure. You'll see here that they've got, as part of their group, they've got their coal segment, if I can almost call it that, and their ferrous, and then other. Then inside that, they had different ways of breaking down, of disaggregating their revenue. Under coal, and I'm not going to pretend to know what all of these things mean, but under coal, they had what they've got as their commercial, Waterberg and Mpumalanga, Tide, and under ferrous, it was alloys. Also under coal, apologies, they had other as well there. So I'm not going to get into the whole issue on other. I could probably sit there for 2 hours and discuss the word other in a set of financial statements to death. Hate it, means nothing, says nothing, don't do it. In some instances, it cuts the mustard because it's so menial. You can see there, 364 versus whatever the bigger picture is. What I'm getting at is that when disclosure adequately addresses each revenue stream, I can see it from the actual policy. So my revenue stream, if I've got, you name it, I'm going to go with an example entity, a set of illustrators. Don't shoot me for it, but these are the ones that I prefer to use, and it's a company that emulates a paper product company. So they've got sale of paper, they've got sale of paper-related products, they've got construction contracts, they've got customer loyalty program, and each of these are identified as different revenue streams. And you'll see those different revenue streams addressed in the policy. So if there's no link, it makes no sense. And we need to just stop ourselves. So the more blah that you write in a set of policies, the less concise you are likely being. So I just want to stress that in terms of the policy requirements, it is most likely going to be a combination of what is being put into the first column here, the nature, timing, satisfaction column, as well as this nature of change in accounting policy. But again, it's up to everybody what suits them. I prefer a more structured approach. If something is in a tabular format, it's easy to read, easy to find, and easy to critique, from my point of view. But I think all they're trying to say here is that we need a link. And where there was a lack of, they raised that as an issue. In the third block, I've got a lack of accounting policies addressing all revenue streams. This, people often say to me, but if it's insignificant, why talk about it? Well, if it's a revenue stream, it was big enough for you to actually create that revenue stream. So if you've bought a subsidiary that had a very menial revenue stream, it's still part of your revenue. It's part of the main focus of, if it's a group or even if it's a smaller, it doesn't really matter. I think it's a difficult one for me to go with materiality. I stay far away from those kind of judgments. Being technical, I think it's a little easier to say, well, put it in. But if you've got a revenue stream that you've listed somewhere in a note, it better have a policy, and vice versa. So these two go hand in hand as a link, but also making sure that we've got all of either addressed, whether it be in the note or whether it be in the policy. Then we take a look at what we were actually talking about a short while ago, specifically looking at contract assets and contract liabilities. So contract assets, the definition is included in Appendix A for both assets and liabilities. Liabilities being more in line with what we were talking about in terms of the old wording. We want to avoid using the old wording, which is income received in advance. Also, revenue received in advance. If it is deferred income, please be careful that it isn't still appropriate to call it deferred income, whatever it might be representing. So we still use deferred income in certain instances, as long as it's not representing your revenue from contracts with customers. And basically what we're trying to say for a contract liability is we owe the customer. So if they've paid us in advance, we still owe them the service or the good or whatever we might do. And we owe them, we've got to make good. With a contract asset, I mentioned it's a pseudo debtor. So it's technically, it's before it becomes where we are entitled, unconditionally entitled to receive the cash. Really, I'm going to just write that, before entitled to cash. But I've done something, so I am entitled to consideration. But it's just not at that point where I have a financial instrument in the sense of IFRS 9. These two things must be addressed in the policies. Again, if we are addressing in some kind of, let me use an example of what I mean. So if we are going to do some kind of tabular format of your revenue stream or revenue type, depending on what wording you prefer, you can have revenue type A and B and C, let's say. And then you're going to talk about similar to the column I had earlier. So the nature, the timing, and the payment terms. You're going to have each of them addressed individually. In line with that, you're going to give me the accounting policy. And if we were doing this a year or 2 years ago, I would have had policy old versus policy new, because that would have told me exactly what you're crossing over from. But now we're just going to have policy new. And we'll talk about when it's recognized. We'll talk about the time, that is timing, right? We'll talk about any amount. And around amount, I'm specifically addressing the transaction price. Are there any financing issues in there? Is it non-cash consideration? Are there refunds? So you'll have told me something about refunds, or you'll have told me that the contract allows me to deliver, but only entitled to cash later, which is getting at this contract asset thing. Or customers pay in advance, which would then result in, I want to see a policy on how do you deal with your contract liabilities. Likewise, another bug that has been raised, a finding that has been raised by the JSE, is whether you have a refund policy. And in so doing, perhaps you have a refund and a return policy. So in other words, if they return something, are they entitled to a cash refund? Or is it a question of that you've limited them that they can only take a replacement item? How long is that refund window open for? How many, what is your percentage? What is it based on? Is it based on historical data that you've used saying this is how many people do this? And for how long have you used that? So did you use your historical data from the year dot? Or have you only assessed the last year or the last 2 years? This is what my customer profile looks like. So you can clearly see that that's kind of what I was heading towards, is just getting a clear tabular format, revenue type, nature, timing, significant payment terms, clearly explains exactly what you do, when you do it, how you get paid, what the policy is. And then obviously my bad for leaving the final column open. That was still in my thinking of old versus new. It could also, in line with what was presented earlier, this could also have been your impact. You could use it for anything really, but ultimately in staying with what's required by IFRS 15, that would really be more than sufficient. You're giving me a policy based on what you do. Don't give me a policy but not tell me what you do. I've seen many financial statements, sadly, that simply say, we sell goods and provide services. That is not at all what the standard wants. It doesn't give me any detail. It doesn't tell me anything really about anything other than you have stuff or you give people some of your time. We really need a full-on policy in that regard. So that's where we headed there. Again, that link of the policies, I hope this draws a bit of clarity for you that if we talk about what happens in an actual stream, that it's very easy then to create or build our relevant policy, even yourself. It doesn't need to be in high language or it's good to stay within the confines of IFRS lingo, but we don't need to be ridiculous about it. The last one is really very specific, but I wanted to make sure that I did highlight everything that was raised as a finding. And this is specific to the financial sector companies, which I'm not too sure that there are too many of those on the call. If there are, really, they were just commenting on the fact there was weak disclosure around accounting policies for non-banking income. Again, if there are any of those out there, any participants listening right now, there are a lot of different illustrators for banking, investments, funds, real estate, you name it. You can go and apply what's applicable to your industry. These were 2 no-nos. I try to make it clear by highlighting that they start with the word inappropriate. So the first one was an inappropriate generic wording in a policy on variable consideration. Now, variable consideration, for those of us that haven't or don't actually deal with it in our companies, we're talking there about discounts. We're talking about your refunds or returns. These are the most common. They can be anything from a commission, a price concession, rebates, you name it. So the policy read, the variable amount. And my first question would have been, what variable amount? It's estimated at the inception of the contract and revenue is recognized at the estimated amount throughout the duration of the contract. I mean, I probably could have highlighted every second or third word when I was doing the preparation for this, because here I'm going, what is the duration of the contract? Which contract does this apply to? Or revenue type for that matter. When the uncertainty, what uncertainty? What uncertainty prevails based on this type of variable consideration? When that's resolved, the entity allocates the difference. Now, I know sometimes it would be obvious, but the difference would be the discount that would have been allowed, or the refund, or whatever. You get where I'm going. And then a variable consideration is only recognized to the extent, and here it goes into the wording that I would want to see, but after you've told me what variable consideration you have. So I'm going to come out and say what my favorite set of illustratives is, and I hope I don't get shot for this. But having dealt with them for most years, and they make the most sense to me, my primary go-to is the KPMG illustrative set of financial statements. And in there, it's quite clear. We keep it concise. We say what the variable consideration is, and we simply go from there. We just say that the refund or the rebate or return has this impact on revenue. In other words, it can reverse my revenue, and it's only recognized when it's highly probable that there won't be a reversal in the future. And we talk about the estimation. The others, Deloitte, PwC, they all have the same. It's just written in a slightly different format where you can clearly see I've kind of cottoned on to the tabular format. It works for me. Each revenue type can then not be mixed with another, but everyone's got their own preference. When we look at the second bullet, an inappropriate generic policy based on progress measure, this is more common than you think. This is where, in this case specifically, it's an over a period of time revenue stream. It's not clear what it is. It just, the policy that they included was, while IFRS 15 represents significant new guidance, management's assessment indicated that the contract performance obligations and related contract costs, what are they? What is the PO? What are the promises, first of all, in the contract? And then what related contract costs that I have are satisfied over time, and that the method used to measure the progress, this is the old stage of completion, towards completion of the contract will continue to be appropriate. It doesn't tell me much about what you did do, so I can't even extrapolate what will happen going forward. I mean, to use the word generic, I think it's doing it a bit of a favor. It's ambiguous, to say the least, and provides very little information on what the company was doing. So in heading in from there, the JSE then said, right, so based on these findings, we've got two things. Slide 20 tells me around the timing of revenue recognition, and slide 21 addresses the judgments around the amount. So these, ladies and gents, are the judgments that we would need to see under your judgments and estimates note, wherever that might be. Or alternatively, in the actual note that relates to revenue. Nothing wrong with that. So keep your judgments where they belong, or alternatively group them all together, whatever floats. But here it says to us that when we are making judgments around timing, please consider, obviously, those that are over versus those that are at a point. And tell me what you've had to evaluate. Tell me what you've had to judge. So for those at a point in time, I have to judge the when a customer gets control. And these questions might seem very straightforward, but when does the customer get control is either when it takes delivery of an item, or when I ship it, or if it's at a point of sale, at the actual point of sale counter. If it's an online customer, is it, again, shipping, or is it delivery? Is it a signature that I need? What is it? What does your business do? And I think that's what's important. I just triggered another thought around, competitive harm information. I think we're also a little bit precious sometimes around what we think is indeed competitive harm. No one's allowed to know what I do in my business. I think, again, we need to realize that we are in 2020, and most of us know exactly what happens with regards to certain things, as to when or what or how you process, because most companies use the same concept. But we've got to be careful. The ISB has said competitive harm, no thanks, not interested in your argument. We need to see what we need to see based on what the standard is asking. So just wanted to get that out there as well, in case there's some of us thinking we can get away with competitive harm. So for those over time, give me the method. But it's not just a question of telling me I've used the output method. What does that mean to you? Give me a description of whether it's input or output, and how it's been applied. I've seen many discussions around the input method, and they can go various different ways. So saying what it is that you do, costs, whatever it might be, it's very, very important and obviously required. And then lastly, on the overtime, just an explanation of why that method was used, why we believe that it faithfully depicts the transfer of goods or services. So faithful depiction is really what this is all about, is about the transfer over a period of time. Is that the right one? Great. Then is it input or output? And although there's no wrong or right, you'll see the standard does say there is what is the most appropriate method to use. Just being down this discussion with a manufacturer of a bespoke item, and it was a question around should they use input, should they use output. They were firm that they used output because they did it based on work done. And then when we boiled down to it, it was actually they were using the billing milestone. And ladies and gents, billing milestones are not completion milestones. They are, when in terms of the contract, they are the times that you're entitled to bill for a cash payment. It is often those dates are often driven by how a project is going to go. When do you need the actual money? But it is not in line with how far you are in a given project at a given time. And that's we've got to be very careful with. So enough judgments in timing. As far as the amount is concerned, we need information about any method, input, or assumption that you use to determine the transaction price, the amount, the number. And that's got to include estimating any variable consideration. We've spoken about that. Specifically, it addresses here time value of money and non-cash consideration. Then assessing whether that variable consideration is constrained, limited, under what circumstances, what puts pressure on it, and then allocating it. So if you've got more than one promise, more than one thing that you are delivering in terms of a contract, on what basis did you give that transaction price to item A and item B? If I can use a cell phone as an example, because that's so easy to grasp, is how much of the transaction price did you give to the handset versus the airtime versus the data versus whatever else is built into it? And then lastly, how did you go about measuring obligations for returns, refunds, and anything else that's similar? These obligations, ladies and gents, we talk about a refund liability. The standard says we want to see that, obviously either in the statements of financial position or somewhere else where it might make sense. I'm not too sure it would make sense under trade, trade and other payables. It's perhaps, there's an argument for it. Like I say, as a purist, I like to start with name it on its own. And then if our balance sheet is getting out of hand, then let's find where these guys can be aggregated. But to simply aggregate so that we don't draw attention, that's not always a starting point. That sits for me. And another finding on key judgments and assumptions was exactly that, the failure to apply the method of progress to either a business in a group or a specific revenue stream, not giving entity-specific explanations of why that method depicted the appropriate transfer. And then my favorite, and you guys should be like, okay, Kim, we get it now. Repeating an IFRS paragraph, please don't. They also told us to avoid, and these are two examples, given the nature of the contracts completed over time, this method provides a faithful depiction of the transfer of goods. That's the standard wording. That is literally that comment around merely repeating IFRS. The JSE raised that finding for this. And the last one was the group records a liability for estimated returns based on historical rates. Argument there was generic, tells me nothing. Historical rates of what? Where is that liability recognized? And what is it called? So the group recognizes a refund liability for estimated returns, whatever it might be. But there's a lot more that would need to go into that policy. Specific disclosure, we come back to this disaggregation. I've mentioned already, IAS 3416L in the interims, give it. If it's not your interims, then at least make sure that, if you're not doing it from a listed point of view, make sure that you get in the habit of providing that info in a management pack, if it's 3 monthly or whatever it might be. We've also discussed that the app should tell a coherent story. Don't provide the conflicting messages. Make sure that users understand the relationship between your disaggregation and your revenue per reportable segment. Again, this is obviously only focusing on listed because they're the only ones that would comply with segments and segment disclosure. But it is a place, a space in the financial statements where people have tried to combine two things at once. And it's because it makes the most sense. So there's no need to repeat info for segments and disaggregation when they can be combined. This here, ladies and gents, is just a slide that I've popped in. It's not at all addressed in the JSE's thematic review. It is simply a reminder of the 7 categories that are given as examples. Nothing that says you can't go create your own, but must make sense, must be in the spirit of the standard. These are the 7 categories that we would want to see our revenue broken down under. Now, we're going to see shortly that most entities, including the ones that the JSE highlighted as good disclosure, went down the path of 3 categories. It just so happens that they were the 3 categories that were addressed in illustrative example 41 of IFRS 15. It seems to be where everybody kind of goes, well, we don't know what to do, so let's use an example. And I'm not sure that people read through all 7, or maybe we just didn't think that the other 4 were relevant or added any value. So we looked at geographical regions, we looked at goods or service types, so major product lines, and then the timing. And that's what comes through then on slide 25. Highlighting, if you're looking at rows, I know this can be a little overwhelming if you're not, au fait with this kind of thing. But timing and major type of good and service. So they've incorporated both. They've said that items that are recognized for at a point in time, and we broke that up into then our type of good or service was coal. I'm not even going to pretend to pronounce that. Ferrosilicon, I think. And then other biological goods. Likewise, our rendering of services, that revenue was obtained over a period of time, so addressing the timing. And then we said that the services that we offered here was stockyard management, other mine management, and then other. And yeah, we'll leave it open to some kind of a debate on another day as to how many others are actually in this note. I count 1, 2, 3, 4, 5, 6. I think about six references to other. So yeah, not particularly ideal, but I think you get the gist of what looks like and is readable as fairly good disclosure. On the next slide, it's the second and third category being geography. And then they actually took a different route and they went by major customer industry. So that one there, I suppose, would then rather fall under market or type of customer, albeit that most that we've dealt with, most that I've seen, I suppose even including the JSE for that matter, appeared to be via based on major project and geography and then the timing. So they've got geography, Europe, Asia, and other. That's however just broken down for export. So domestic is domestic. I would probably still question what does domestic entail. I know we've dealt with a couple of South African groups, Alvin, where we've looked at what does domestic mean. Are we looking at Southern Africa? Are we going to break it down into South and then neighboring countries? I think you can get where we're going with that. And major customer industries, they just went with public utilities, merchant steel, mining, manufacturing, cement, and again, our other pops up. So pick your category. Does the category have to remain same year on year? I think that would make sense. But should there be some kind of realignment of how revenue is disaggregated, looked at, reviewed, considered? It wouldn't be wrong to then explain to the user how it's changed year on year. So you'll obviously have a comparative period where you're aligning both. The following one, just a smaller extract. This one here addressing geography, major product, service, and timing. This here is very much what we see in illustrative example 41. It ties up to the revenue as reported. This will no doubt you would have seen if you were looking at this sample entity's financials, you would have seen 10.2 million recognized on the face. And then the managed associate being excluded specifically for that purpose. So if you were to add it, your segment revenue apparently would increase in each of the three different categories by the 1.1 odd billion, it looks like. So giving you an idea, we can use what's been given to us. We can recreate. The JSC are quite happy with what is being presented here. It seems to tick the relevant boxes. You might recall in the first half of today's session, I mentioned silence is not always the best approach. This is where if something doesn't apply to us, it doesn't always make sense to just keep quiet about it. So if we have or don't have obligations for returns, maybe saying something about that would help. In other words, we have non-refundable, when we receive our non-refundable fees or our payments are non-refundable in any way, shape, or form. That also tells me I don't need to be looking for a return obligation. Types of warranties and the related obligation, we've seen some entities there not being clear that they don't have warranties. So again, keeping quiet leaves space for don't make me fill in the gaps kind of situation. Then an issue that seems to rear quite a bit, and when Alvin and I embarked on this with a couple of entities that we assisted, we asked under every single revenue stream, was there a right to return goods? The reason for that is that we need a specific policy to address it. How does it work? And in addition, then we need disclosure of that refund liability that I mentioned, whether it's long-term, short-term, it's probably in all likelihood going to be current. And then obviously the corresponding asset to the right to recover the goods. So if you've got a refund liability, it also means you have the right to get the good back from the customer. Now doing that means I need an asset. This, ladies and gents, is nothing more, nothing less than pseudo inventory. It's my inventory, but if I keep it in inventory, I might try and sell it to somebody else and it's already out there. So until such time as my refund period is up and I know for a fact it's cost of sales, or alternatively until such time as they refund it to me, I've got to put it in that pseudo asset account, and that's what we call it. So you'd want to see a policy and the relevant deeds there. Lastly, I've spoken about this one as well, and again, just to highlight, there seemed to be quite a prolific finding that in terms of the transitional requirements that we see, and I'm just going to highlight it again for you, IS 828 says, any new standard, give me the blah, blah, blah about what standard, when, how, who, all of that jazz, but then give me each line item's effect. And ladies and gents, that includes, if you're listed, EPS. Oh, absolutely. So sorry, Alvin's just trying to keep me on track here for time, as well as just to a reminder that this is important for IFRS 16. So obviously, all these findings, if you can kind of, instead of hitting yourself with a stick going, oh, well, we missed that one, try and channel them into getting it right then for IFRS 16. So each line item and EPS. Be careful, don't give a generic discussion of the change in accounting treatment. that's just a waste of time for everybody. Also, in lieu of the new standard coming up, IFRS 16, maybe you want to be a little bit careful about talking too much about what happened under IFRS 17. Yes, give the background, but be concise and get on with what you're actually doing, because that's what we want to see is the impact, what's going to happen. And then they also raised the finding that there was no disclosure for amounts that were previously recognized over a period of time, and now recognized upfront. The one that comes to mind is there was some discussion at some point around telcos recognizing the revenue on handsets over the period of the handset, the contract. And so there could have been certain, I think this might have been a very isolated incident, but nonetheless it was raised as a finding in the report. Ladies and gents, that pretty much brings us to the end of today's session on IFRS 15. As you've seen, so we'll talk a little bit more about the IFRS 9 ones on Thursday at 2 p.m. as well. Yeah, we understand it's a full week. Wednesday is budget speech. So we in the beginning, we incorrectly addressed or wanted to address the second half on Wednesday, but some of you also want to pay attention to the budget speech. So we will go live then with you guys on Thursday afternoon again on IFRS 9. In the meantime, though, and it was really just from a looky-loo, a picture point of view, and by no means did I intentionally pick any of these other than these are the ones that I generally go to. You've got KPMG, Deloitte, PwC, BDO, and EY. These are just the look and feel of their latest, so the 2019 illustrators. Downloadable, very easy to navigate, search and find. They are copy and pastable, so if you want to take something out of there and make it your own, really, really, really great publications to utilize going forward. And other than that, I guess it's, thank you to each of you for dialing in, for staying engaged with us. Not the easiest thing having to listen to someone for 2 hours on iPhone 15, but really grateful for your time, for dialing in, and Earl for you and your team, for you, Clarissa, Alvin, for you sitting here and having to listen to me for the 150th time, no doubt. It's always it's a privilege, but I'm sure for Alvin by now it's a pain that cannot be explained. So thanks again for your time, and we'll see you again on Thursday, Earl.
Perfect. Thanks, Kim. Thank you for taking your time out. Thank you for allowing us to sponsor your time. Guys, I've just got a quick poll. If you are interested in something like an IFRS 16 webinar, to have Kim go over all the ins and the outs, let us know. Ooh, and it's mostly all yes. Okay, shit.
Yay!
A lot. It's 98%. Okay, only 10% what no. So I think that's a yes, Kim. So let me know your rate, please, for and availability. To all the DraftWorks users, thank you for your support. The next one's on us as well. So thanks, Kim. We'll see everybody on Thursday. I will distribute these, the slides and the videos.
Yes.
Kim, can you save those slides with all your commentary on it?
I definitely can. Yes.
Yeah,
So
I think that would help a lot of people.
Okay, perfect. Well, if you want that then to rather be distributed, I'm very happy to do that. So just save it. I put it in a PDF format, and they can log in like that and view like that then. Perfect.
Thanks.
Awesome.
So
Thank you, everybody.
I'll upload the video tomorrow, or probably tonight, guys, to our YouTube channel, DraftWorks YouTube channel. If you aren't subscribed, just go and Google DraftWorks team. Otherwise, the links will also be in-app in DraftWorks tomorrow. You can just jump to this, and I'll link the download for these slides in that video. Okay. Kim, Alvin, always a pleasure. Thanks so much.
Excellent.
I'll see you Thursday.
Till Thursday.
Thanks, guys.
Cheers, everybody.
Bye.
Have a good
Cheers,
one. Bye.
Bye.
Bye.